You may be hearing more and more about stock valuations being high. That's certainly true. On an absolute basis, the current price-to-earnings ratio for the MSCI U.S. stock index is elevated. Investors are willing to pay over 22 times for next year's expected earnings. We can also look at relative valuation, and relative to history, that 22 times seems high against the long-term average multiple of just under 16. Now, we can debate whether the E or the earnings is understated. We can debate whether it's different this time, and whether we may be in a period of a regime change where valuations will be more permanently higher. Some, though, are even saying that today's currently high valuations mean we're soon to have an equity correction. So, lots of attention on valuation. For us, though, the salient question is whether a focus on today's valuation as any kind of predictor of market moves makes sense. So do current valuations contain valuable information for those trying to predict the future? Let's break it down. So the good news is that we can do a simple analysis to determine the answer to that important question. The definitive conclusion is no. Out to a 5-year time horizon, there is no discernible correlation between today's price-to-earnings level and forward returns. In fact, you need to go out 10 years to get a correlation close to 50%. That effectively means that today's multiple of earnings explains about 50% of the forward returns, leaving the other 50% to be influenced by other factors. So are there better valuation metrics to use? Yes. We can look at cash flow yield, and we increase the predictive nature to over 60% over a 10-year period, but that still leaves 40% of that forward return explained by something else. What we do know, and what is just intuitive, is that a high starting valuation level likely means lower forward returns, lower than historical average, because investors today are baking in those lower return expectations into today's high prices. Investors are effectively demanding and accepting a lower return for taking on equity risk. Now, that may be a function of interest rates, could be a function of benchmark composition. There are any number of reasons why this is the case. It's an important point, though, and one that we've incorporated into our own capital market assumptions. We anticipate mid-single-digit returns for equities over the next several years, and for investors, it'll be imperative to get their fair share of those lower returns. This means taking a long-term time horizon and living through inevitable volatility, and for taxable accounts, it will require a focus on tax management.